Today, is inflation getting sticky? A market update for the 14th of October 2021. Hello again, it's Martin North from Digital Finance Analytics, where I latest posts covering finance and property news with a distinctively Australian flavour. In today's show, we look at the latest on US inflation, released on the same day the Fed published their latest minutes. Lots for the market to digest and many conflicting signals, but it does seem inflation is getting more embedded. Following the data overnight, interest rate swaps briefly priced in a September 22 rate hike before pushing it out to November. But folks, rates are likely to be moving higher and quite soon. The S&P 500 and the Nasdaq ended higher on Wednesday, led by gains in shares in big growth names like Amazon.com and Microsoft, but JP Morgan shares fell along with the other bank shares and weighed on the market. The Dow Jones Industrial Average fell 0.53 points to 34,377. The S&P 500 gained 0.3% to 4,363, and the Nasdaq Composite added 0.73% to 14,571. The S&P 500 briefly added to gains following the release of minutes from the September Federal Reserve policy meeting. US central bankers signalled they could start reducing crisis-era support for the economy in mid-November, though they remain divided over how much of a threat high inflation poses and how soon they may need to raise interest rates. Federal Reserve officials have called the current inflation run transitory and attributed it largely to supply chain and demand issues that they expect to subside in the months ahead. However, that view has been receiving substantial pushback lately. But the Labour Department report showed consumer prices increased solidly in September, further strengthening the case for a Fed interest rate hike. A combination of unprecedented shipping challenges, material shortages, high commodity prices, and rising wages have sharply driven up the costs for producers. Many have passed some portion of those costs along to consumers, leading to more persistent inflation than many economists, including those at the Federal Reserve, had originally anticipated. The pickup in price growth seen last month reflected higher food and shelter costs. Meantime, measures of used cars and trucks, apparel, and airfares actually cooled. US stocks opened higher, while the yield on the 10-year Treasury declined. Signs that price pressures are beginning to emerge in stickier areas of the economy, such as rents and owners' equivalent rents, will test the Federal Reserve's ongoing narrative that inflation remains transitory. Price pressures are shifting to the stickier components and will make the Fed's transitory thesis more difficult to defend, Jeffries said in the note. The 10-year inflation break-evens, a key measure of inflation expectations over the next decade, climbed to 2.53%. That's the highest since May 2018. A further increase in the pace of the inflation could flip the relationship between bonds and stocks and pressure the overall market lower. Once 10-year break-evens go above 2.5%, stocks and bonds tend to move in the same direction. Christopher Schon, senior principal at applied research at Quantagio, told Investor.com in an interview on Wednesday. If we were to see a further increase in break-even inflation rates, then we would see a simultaneous sell-off of the stock and the bond markets continue. Shares of JP Morgan Chase fell 2.6%, even though their third quarter earnings beat expectations helped by global deal-making and the release of more loan loss reserves. The stock declined along with the other bank shares and were among the biggest drags on the S&P 500 and Dow, which ended flat. This is because momentum in their loan books was a lot lower than expected. The S&P 500 bank index was down 1.3%, with longer-dated treasury yields down on the day. BlackRock gained 3.8% after the world's largest money manager beat quarterly profit estimates as an improving economy helped boost its assets under management, driving up fee income. The day's corporate results kicked off the third quarter earnings for the S&P 500 companies. My hope is that as we work our way through earnings season, that the forward-looking guidance will be good enough that we'll close the year higher. But right now, the market is in a show-me phase, said Jim Edwin, Senior Managing Director at Clearstead Advisors in New York. Megacap growth names including Amazon, the Google parent Alphabet, and Microsoft all rose, but Apple dipped 0.4% after a report said that the iPhone maker was planning to cut production of its iPhone 13. Also in earnings, Delta Airlines fell 5.8% after the company reported its first quarterly profit without federal aid since the coronavirus pandemic, but warned of a pre-tax loss for the fourth quarter due to a sharp rise in fuel prices. Analysts expect corporate America to report strong profit growth in the third quarter, but investor worries have been mounting over how supply chain problems, labour shortages and higher energy prices might affect businesses emerging from the pandemic. Bank of America, Citigroup, Wells Fargo and Morgan Stanley will report on Thursday, while Goldman Sachs is due to report on Friday. But inflation was the talk of the town, with the New York Fed releasing their underlying inflation gauge, their UIG, for September today. The prices only underlying gauge is derived from a large number of disaggregated price series in the Consumer Price Index, while the full dataset measure incorporates additional macroeconomic and financial variables. The UIG full data set measured for September is currently at 4%. That's a 0.1 percentage point increase from the previous month. The prices only measure for September is currently estimated also at 4%, and that's a 0.1 percentage point decrease from the previous month. The 12-month change in the September CPI was 5.4%, and that was a 0.1 percentage point increase from the previous month. And for September 21, the trend CPI inflation is estimated to be 4%. And note that the COVID-19 outbreak continues to impact data collection for the CPI release. More broadly, according to the Labour Department, consumer prices increased slightly more than expected in September as food and energy price rises offset declines in used cars. The consumer price index for all items rose 0.4% in the month, and that was slightly higher than estimates, which were sitting at around 0.3%. On a year-on-year basis, prices increased 5.4% versus 5.3% estimates, and that's the highest since January 1991. But excluding volatile food and energy prices, the CPI increased just 0.2% on the month and 4% over the year against respective estimates of 0.3% and 4%. Dow futures were slightly positive following the news but fell sharply through the morning, while government bond yields were mostly lower as investors gravitated towards safe haven income. Gasoline prices rose another 1.2% for the month, bringing the annual increase to 42.1%, and fuel oil shot up 3.9% for a 42.6% year-over-year surge. Food prices also showed notable gains for the month, with food at home rising 1.2%. Meat prices rose 3.3% just in September and increased 12.6% year-over-year. Food and energy are more variable, but that's where the problem is, said Bob Dole, Chief Investment Officer at Crossman Global Investments. Hopefully, we start solving our supply shortage problem, but when the dust settles, inflation is not going back to 0 to 2%, where it was for the last decade. Used car prices, which have been at the centre of much of the inflation pressure in recent months, fell 0.7% for the month, pulling the 12-month increase down to 24.4%. But the continued rise in prices, even with the drop in vehicle costs, could lead credence to the notion that inflation is more persistent than policymakers think. Airfares tumbled 6.4% for the month after falling 9.1% in July, and shelter prices, which makes up about one-third of the CPI, increased 0.4% for the month and are up 3.2% for the 12-month period. Owner's equivalent rent, or how much an owner of a property would have to pay to rent it, increased 0.4% as well, its largest monthly gain since June 2006. This might just be an overshoot after a couple of relatively modest increases, but we can't rule out the idea that the fundamentals, rapid house price gains, more aggressive landlord pricing, low inventory, and faster wages growth are pushing up the trend, wrote Ian Shepherdson, Chief Economist at Pantheon Macroeconomics. Apparel prices declined 1.1% in September, while transportation services dropped 0.5%. Both sectors have been rising consistently and still showed respective annual gains of 3.4% and 4.4%. Federal Reserve officials have called the current inflation run transitory and attribute it largely to supply chain and demand issues that they expect to subside in the months ahead. However, that view has been receiving substantial pushback lately. This is one more data point to say, Fed, you're trying to convince us that inflation is transitory is just not believable, Dole said. If you know anybody who doesn't have to live somewhere, doesn't eat any food, and doesn't use energy, then inflation is maybe not a particular problem, but come on. As I discussed yesterday, the IMF warned that the Fed and its global peers should be preparing contingency plans should inflation prove persistent. That would mean raising interest rates sooner than expected to control the price gains. In fact, later in the day, St. Louis Fed President James Bullard told CNBC that he thinks the Fed should be more aggressive in withdrawing its economic support, and in particular its monthly bond purchases should inflation prove a problem and require rate hikes next year. And also on Tuesday, Atlanta Fed President Raphael Bostic said the factors that have pushed inflation higher will not be brief. Today's number shouldn't move the needle for the Fed, said Seema Shah, chief investment strategist at Principal Global Investors. Inflation has already surpassed its goal, and if anything, the higher than expected September CPI just reinforces the need to start tapering. November tapering, here we come. JP Morgan Chase CEO Jamie Dimon on Monday took the transitory side of the argument, saying that the current conditions will clear up and the inflation won't be a factor in 2022. Energy cut some losses as oil prices recover from seasonal lows on expectations that demand will continue to strengthen. And in fact, the Russian President Vladimir Putin said it was quite possible that oil prices could top $100 per barrel. Prices paid by US consumers rose in September by more than forecast, resuming a fast pace of growth and underscoring the persistence of inflationary pressures in the economy. The CPI data reflects cross currents in the economy. Hotel fares fell, reflecting the impact of the Delta variant on travel, but inflation is broadening out beyond categories associated with reopening. That's worrisome from the Fed's perspective, Bloomberg Economics said in a note. Higher home prices are now starting to filter through into the data. Rent of primary residence jumped 0.5%, the most since 2001, while a measure of homeowners' equivalent rent posted the biggest gain in 5 years. Shelter costs, which are seen as a more structural component of the CPI and make up around a third of the overall index, could prove a more durable tailwind to inflation. The report will likely reinforce the Fed's inclination to start tapering soon its asset purchases, especially as the supply chain challenges plaguing businesses show little sign of abating. Between now and the medium term, investors need to be braced for data which will appear at least to threaten the transitory story, Ian Shepherdson, chief economist at Pantheon Macroeconomics, said in a note. American consumers are also experiencing higher prices for new vehicles and household furnishings and supplies, which increased by a record 1.3%, the report showed. And looking ahead, elevated energy prices are set to take an additional bite out of workers' paychecks. A New York Fed survey out on Tuesday showed that US consumers' expectations of inflation continue to rise in September, with 1 year and 3 year expectations accelerating to record highs. While wages have strengthened in recent months, higher consumer prices are eroding America's buying power. Inflation-adjusted average hourly earnings rose just 0.2% in September from a month earlier, but are down 0.8% from a year ago. Separate data, also out on Wednesday, showed. To help offset higher prices, more than 64 million retirees collecting Social Security benefits will see a 5.9% increase in their monthly payments in 2022, the Social Security Administration said on Wednesday. Come January, beneficiaries can expect to see one of the largest increases in monthly benefits, not only in their time on the program, but in the program's past 40 years, said Jason Fisher, chief economist at the Bipartisan Policy Center. Now, the point of all this is that there's a critical tension between the short-term and long-term issues with regard to inflation. Is it transitory or not? The more you look at the data and the more you look at the types of things being impacted, the more likely it is that inflation is embedded. And if it is embedded and it flows into more wage growth ahead and higher cost prices, that means that many households will find their budgets under significant pressure. That in turn will decrease spending momentum and also make it harder to deal with the broader issues. And of course, if interest rates are taken higher by the Fed to try and quell inflation, that will put more pressure on consumers too. We are, I think, in the twilight zone here between low rates and high rates and between transitory inflation and structural inflation. The concern I have is that we could see policy missteps if in fact transitory inflation is being misinterpreted as structural inflation. On the other hand, if inflation is structural, then they better do something about it, and quick, as the IMF says. I wonder which side of the fence the Fed will come down on in November. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.